Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Regeneron Pharmaceuticals, Inc. annual report. Regeneron Pharmaceuticals, Inc. offers a diverse range of medicines to treat various diseases worldwide. The company's product portfolio includes treatments for eye diseases such as wet age-related macular degeneration, diabetic retinopathy, and neovascular glaucoma. They also provide medications for allergic and inflammatory conditions like atopic dermatitis and asthma. In addition to these, Regeneron offers treatments for cardiovascular and metabolic disorders, including heterozygous familial hypercholesterolemia, HoFH. Their product line also includes medicines for neurological diseases, such as relapsed multiple myeloma and CD55 deficient protein-losing enteropathy. Furthermore, the company provides treatments for infectious diseases like infection caused by Zaire ebolavirus. Regeneron's portfolio also includes cancer treatments, including metastatic or locally advanced cutaneous squamous cell carcinoma and metastatic colorectal cancer. They offer a range of injectable solutions, including Dupixent, Libtayo, Praluent, Kevzara, Inmazeb, Arclyst, Zaltrap, Evkeeza, Ordspono, Linezolid, and Viapaz. The company has partnerships with various organizations to develop and commercialize new treatments, including Bayer, Alnylam Pharmaceuticals, Intellia Therapeutics, Hansoh Pharmaceuticals Group Company Limited, and Tessera Therapeutics, Inc. Regeneron's product list includes Eylea injections for eye diseases, Dupixent injection for atopic dermatitis and asthma, Libtayo injection for cancer treatment, Praluent injection for heterozygous familial hypercholesterolemia, HoFH, Kevzara solution for rheumatoid arthritis, Inmazeb injection for infection caused by Zaire ebolavirus, Arclyst injection for cryopyrin-associated periodic syndromes, Zaltrap injection for intravenous infusion to treat metastatic colorectal cancer, Evkeeza for HoFH, Ordspono for follicular lymphoma, and diffuse large B-cell lymphoma, Linezolid for relapsed multiple myeloma, Viapaz for CD55 deficient protein-losing enteropathy. Regeneron Pharmaceuticals, Inc. has a long history of innovation in the pharmaceutical industry, with its incorporation dating back to 1988. The company is headquartered in Tarrytown, New York, and continues to develop new treatments through partnerships and collaborations with other organizations. Regeneron Pharmaceuticals, Inc. has experienced a slight increase in its stock price over the past year due to several key factors. One major contributor is the company's continued success with its flagship product, Eylea, which treats age-related macular degeneration and diabetic retinopathy. Strong sales of this medication have driven revenue growth, boosting investor confidence. Another significant factor is Regeneron's pipeline of innovative treatments in development. The company has made notable progress in advancing several promising candidates through clinical trials, including Libtayo for skin cancer and Dupixent for atopic dermatitis. Positive trial results have generated excitement among investors, who see potential for these new therapies to become blockbusters. Regeneron's strategic partnerships with other industry leaders have also contributed to its stock price increase. Collaborations with companies like Sanofi and Bayer have expanded the company's reach and created opportunities for growth in emerging markets. These partnerships demonstrate Regeneron's ability to adapt and innovate, further solidifying investor trust. Lastly, the company's commitment to investing in research and development has paid off, yielding a robust pipeline of new treatments. This focus on innovation has allowed Regeneron to stay ahead of competitors and capitalize on emerging trends in healthcare. As a result, investors have become increasingly optimistic about the company's long-term prospects, driving up its stock price. Regeneron Pharmaceuticals, Inc. market capitalization of $82 billion is significantly larger than the average industry peer of roughly $2 billion. This shows that Regeneron Pharmaceuticals, Inc. holds a significant advantage in their industry. Regeneron Pharmaceuticals, Inc. trades at a higher price-to-earnings ratio of 19 times and a higher price-to-book ratio of 2.54 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The balance sheet appears very conservative, with liabilities representing only 22% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. The primary drivers of revenue growth for Regeneron Pharmaceuticals are largely attributed to its collaboration with Sanofi. This partnership has significantly contributed to the company's profits, making it a crucial factor in their financial success. However, this reliance on a single major customer also poses a concentration risk, as the loss of this partnership could have a substantial impact on the company's revenue. In addition to the Sanofi collaboration, Regeneron's adoption of new accounting standards may also influence its financial reporting and analysis. These changes, such as ASU 2023-9 and ASU 2025-6, are expected to affect how the company accounts for income tax disclosures and software costs, respectively. Regeneron's share repurchase programs have also been a significant factor in managing its outstanding shares and increasing earnings per share. With $1.486 billion remaining available for share repurchases as of December 31, 2025, the company is well positioned to continue reducing its outstanding shares and potentially boosting its financial performance. Overall, Regeneron's revenue growth and financial management are closely tied to its partnerships, accounting standards, and share repurchase programs. By understanding these key drivers, investors can better assess the company's prospects for future growth and success. The net income of a company underwent significant fluctuations between 2023 and 2025. Initially, it increased by 2.1% from 2024 to 2025, indicating a slight improvement. However, this trend was reversed in the subsequent year, with a decrease of 2% from 2025 to 2026. The profit margins also experienced changes during this period. Although not explicitly stated, the net income margin showed a decline from 31.1% in 2024 to 31.4% in 2025. This trend was consistent with the overall decrease in net income. Several factors contributed to these changes. The company faced challenges such as loss of market share to bevacizumab and reduced sales due to insufficient copay assistance, pricing pressures on biologics, and dependence on third-party payers and reimbursement mechanisms. Additionally, reduced formulary coverage and reimbursement levels, increased competition from generic or biosimilar products, government price controls and regulations, and changes in patient copay and coinsurance obligations also impacted the company's sales. Furthermore, the COVID-19 pandemic had a significant impact on operations, while indebtedness limited access to capital markets. Changes in foreign currency, exchange rates and delays or difficulties in implementing new ERP systems and other information technology improvements also affected the company's performance. These factors collectively contributed to the fluctuations in net income and profit margins during this period. The company's ability to generate positive operating cash flow has been a topic of interest. While some pages suggest that this is indeed the case, others fail to provide concrete evidence to support this claim. However, one page explicitly states that the company is generating positive operating cash flow. According to page 88, the company's operating cash flows have increased significantly from $4,420,500,000 in 2024 to $4,978,900,000 in 2025. This substantial increase suggests a strong financial performance and supports the notion that the company is indeed generating positive operating cash flow. In conclusion, based on the information provided, it appears that the company is generating positive operating cash flow, with page 88 offering the most concrete evidence to support this claim. The company's debt level has shown some minor fluctuations over the past year. According to financial reports, long-term debt increased by a mere 0.08% from 2024, indicating a relatively stable financial position. However, there is a notable contingent reimbursement obligation of $595 million owed to Sanofi as of December 31, 2025, which is significantly higher than the previous year's amount of $296 million. Despite these changes, interest expenses do not appear to have undergone any significant shifts. Regeneron Pharmaceuticals management is optimistic about the company's outlook, citing strong financial performance in 2025. The company's net income reached $4.5 billion, with basic and diluted net income per share of $43.07. This growth can be attributed to its successful collaborations with Sanofi, which have significantly contributed to revenue. The company's management is also focused on maintaining a strong equity position, with available cash and cash equivalents of $3.1 billion as of December 31, 2025. Additionally, the board of directors has authorized share repurchase programs, including one for up to $3 billion of common stock, which was approved in February 2025. While the company faces various lawsuits and disputes, management's emphasis on financial performance and equity position suggests a positive outlook for Regeneron Pharmaceuticals' future growth. The company's research and development expenses have also increased, indicating investment in new projects and initiatives that are expected to drive revenue growth. Overall, management's strategy appears to be focused on building on the company's existing strengths while investing in new opportunities for growth. The company's dividend payment history is well documented in the extracted summaries. It is clear that the company has paid dividends since initiating a quarterly cash dividend program in 2025. In fact, it declared a cash dividend of $0.94 per share in January 2026, following an initial dividend of $0.88 per share in 2025. On the other hand, the information regarding share buybacks is less consistent. While some pages indicate that the company has bought back shares, others suggest otherwise. However, it appears that the company did authorize a share repurchase program to repurchase up to $3 billion of its common stock in 2025. As of December 31, 2025, $1.486 billion remained available for share repurchases. This suggests that while there may be some discrepancies in the information provided, it is likely that the company has indeed bought back shares at some point. Concerns about inventory buildup and supply chain disruption are evident in the extracted summaries. One of the primary concerns is the risk of excess inventory due to delayed product launches or lower than expected sales, which could lead to costs associated with writing down or off inventory. The company's reliance on collaborators and contract manufacturers also poses a significant risk, particularly if they fail to meet regulatory requirements or perform effectively. This could result in supply chain disruptions, delays, and potential losses due to distributor-customer concentration. Regulatory issues, such as noncompliance with CGMP requirements, have already delayed FDA approval of certain products. Additionally, geopolitical developments between the U.S. and China pose a risk to raw material sourcing from Chinese suppliers. Tariffs on raw materials and other necessary products could also impact supply chain operations. Furthermore, concerns about Bayer's performance in commercializing EYLEA HD and EYLEA outside the U.S. add to the uncertainty surrounding supply chain disruptions. Overall, these risks highlight the potential for inventory buildup and supply chain disruption to have a material adverse impact on the company's business, prospects, operating results, and financial condition. That concludes the financial summary for Regeneron Pharmaceuticals, Inc. Feel free to comment below, and I will be happy to answer them when possible.